All right, let's get right into it. It is the summer of 2026, and we're watching a totally historic, almost surreal split-screen moment on Wall Street right now. On one side, artificial intelligence is literally minting massive new fortunes minute by minute. But on the exact same day, we're seeing unprecedented, brutal collapses for traditional tech giants. It's a true tale of two entirely different markets operating at the exact same time.
So we're hitting the ground running today in this explainer to unpack this high-stakes collision that's driving all this global volatility. I mean, think about it. What actually happens when an insatiable, wild appetite for AI infrastructure collides head-on with a Federal Reserve that is absolutely determined to keep a tight leash on the economy? Well, this clash is reshaping everything from Wall Street bank earnings all the way down to rural American farmland.
Let's put a number on it. $69 billion. That massive figure is the exact amount of market value legacy tech giant IBM just wiped out in a single day. $69 billion. That 25% plummet set a grim historical record for the company. It's actually their absolute worst one-day drop since data tracking began way back in 1972.
And you know, this perfectly illustrates the stark reality of today's landscape. On one hand, you've got euphoric Wall Street banks just raking in profits from bustling trading floors and blockbuster public offerings, like SpaceX, for instance. But sitting right next to that euphoria is an absolute cratering of traditional tech shares like IBM. To really understand this violent split, we need to zoom out for a second and look at the larger macroeconomic forces at play.
Okay, let's start with the macro playing field. U.S. inflation actually cooled significantly to 3.5% in June. That's a pretty noticeable drop from the 4.2% we saw in May, and it even beat the 3.8% expectations. This much-needed reprieve was largely driven by a big drop in gas prices following a temporary ceasefire agreement with Iran, which really just proves, once again, how global geopolitics directly dictate the prices you and I pay at the pump.
But here's where it gets interesting. Despite that cooling inflation data, newly appointed Federal Reserve Chairman Kevin Warsh is remaining fiercely hawkish. Warsh arrived at the Fed in May, and he just went before lawmakers and essentially pledged no tolerance for persistently elevated inflation. He's aggressively forming new reform task forces, bringing in heavyweights like former Walmart CEO Doug McMillon and venture capitalist Mark Andreessen. Warsh is telling Congress point blank he will not hesitate to keep inflation crushed, which really pushes back against anyone hoping for immediate interest rate cuts.
So, moving to the market reaction, let's look at the big winners in this current climate. The nation's biggest banks, we're talking JP Morgan, Goldman Sachs, Bank of America, Citi, and Wells Fargo, they just posted a collective quarterly earnings boom of over $49 billion. Just take a second to process that. That is a staggering amount of capital flowing through the financial sector in just 3 months.
And what's fueling this? Well, driven by red-hot debuts like the massive SpaceX IPO, Wall Street is totally cashing in on the AI financing rush. That $49 billion represents a massive 39% jump in collective earnings. Goldman Sachs, for example, literally more than doubled its equity underwriting fees to nearly $1 billion, heavily assisted by leading that SpaceX IPO. As JP Morgan CEO Jamie Dimon put it, the current environment for these banks is, quote, close to as good as it gets.
But you know, the banks financing the AI revolution, that's really only half the story. The traditional tech companies are taking an absolute beating right now. IBM's 25% single-day collapse came with a rare profit warning from their CEO, Arvind Krishna. He basically admitted the company faltered because they simply didn't anticipate the sheer magnitude of how rapidly their clients were shifting their spending.
The crucial mechanism driving this whole shift is a concept called CapEx reprioritization. Basically, banks and major corporations only have a finite amount of money to spend on technology. So right now, they are slashing their traditional software and consulting budgets to hoard cash for massive, highly expensive AI infrastructure and memory chips. They are terrified of missing out on the AI boom, and that leaves legacy software companies like IBM essentially starving for revenue.
Now, building all that AI infrastructure requires immense physical resources. It isn't just, invisible code floating in the cloud. It demands sprawling, heavy-duty industrial data centers. And this is sparking a fierce, on-the-ground battle over land, over power grids, and local resources. It's drastically changing the actual physical landscape of American infrastructure.
Which brings us to what's being called the Great Data Center Divide. Rural families in places like Salem Township, Pennsylvania are quite literally striking it rich. Developers are buying up family farms for an average of $330,000 an acre to build these AI data centers, turning everyday farmers into multimillionaires overnight. But in stark contrast, states like New York, led by Governor Kathy Hochul, are enforcing strict one-year moratoriums on these exact same sites. This is driven heavily by local NIMBYism and intense anxieties over the massive power consumption these data centers require.
Of course, this massive reshuffling of capital, from software to hardware, from tech giants to rural landowners, is naturally spilling over into the opinion pages. It's sparking some incredibly fierce editorial debates over who actually controls and who ultimately pays for this new economy. So let's look at what the thought leaders are arguing about right now.
One of the absolute biggest debates at the moment centers on demographics and taxation. We have a rapidly shrinking ratio of workers to retirees. It's down from 5-to-1 back in 1960 to less than 3-to-1 today. So politicians are scrambling for new revenue to fund public obligations. You have figures like California's Gavin Newsom pushing really hard for national minimum taxes on Americans worth over $100 million, arguing that the extremely wealthy simply must step up to fund this demographic shortfall.
But presenting the counter-argument, editorial critics are pushing back hard on this. WSJ opinion writer Dimitri Burstein argues that taxing capital to fund present consumption is ultimately going to destroy the productivity needed for our future economy. Their perspective is that if you strip investment capital away today, it inevitably leads to slower growth and lower wages tomorrow. In their view, it effectively punishes the younger working generations to pay for current retirees.
Okay, moving to another fierce debate, we have the huge legal liabilities surrounding debanking. If you aren't familiar, this is the highly controversial practice where major banks systematically deny credit or close accounts for industries that are perfectly legal but politically disfavored. We're talking about sectors like firearms, private prisons, and payday lending.
For years, banks justified these coordinated account closures by claiming these industries posed a reputational risk. But in a massive shift, federal regulators, specifically the OCC and the FDIC, have just completely stripped away this reputational risk defense. They've eliminated the primary rule that gave banks the cover to deny services based on subjective reputational concerns.
And what you really should take away from this regulatory reversal is the massive legal exposure it just created. Opinion writers like Jay Rogers are pointing out that this leaves major bank boards highly exposed. Think about it. 5 years of board-level decisions to debank legal businesses are now completely open to impending lawsuits. Shareholders and the very businesses that lost their bank accounts are now legally positioned to test this in court, basically arguing the banks failed their fiduciary duties. This is a big deal because it threatens to unleash a massive wave of disruptive litigation all across the financial sector.
So as we wrap up this explainer, I want to leave you with a final thought to really chew on. We are watching massive macroeconomic plates shift right beneath our feet. From historic Wall Street profits and the skyrocketing demand for AI data centers to traditional tech giants cratering and regulators fundamentally rewriting the rules of modern finance, the landscape is changing so rapidly. The question is, as this new economy takes shape, where will you find yourself standing? A winner or a casualty? Thanks for joining me on this deep dive, and as always, keep your eyes on the data.